Greetings, my name is Kevin Matthews, and I want to welcome you back to the Tax Academy, where class is always in session because the learning never stops. Essentially, what we're going to talk about today is a little bit more of a complicated level, something we're talking about in Season 2. In Season 1, we talked about a lot of, baseline stuff, and as long as that baseline stuff doesn't really change, there's really no need to rehash it. I mean, the information is probably just as good as it was before. One of the things that we're going to talk about today, of course, is the conversion of a partnership to a limited liability company. Now, some of my accounting friends are going to take a look at this and kind of go, this is really a topic. And from a tax perspective, it is, but it's not. Okay, and I'm gonna tell you something. When I first saw this topic as a potential topic that we were kind of talking about, that's the first thing I thought about was that, wait a minute, why would you even talk about this? Because, and here's kind of the reason why. Limited liability companies by themselves don't have a specific tax regime that they have to follow. Okay, there's actually a very interesting history of the limited liability company. I'll probably try to make a video on that at some point once I get a little bit more research into it. That's not something that I can go to my tax research engine and pull off, a significant amount of it. That's something I'm going to have to actually spend an exorbitant amount of time looking into and making sure I get my facts right and dates and all that sort of stuff. I know generally what the history is, but when you talk about historical stuff, hey, we always want to make sure we get things right. Suffice to say that, obviously corporations are taxed under the corporate tax structure. S corporations are taxed under the S corporation tax structure. Partnerships are taxed under the partnership tax structure. And then you have this thing called sole proprietorships, which are taxed under their structure. Now, the structure, and we say just sort of the structure of a sole proprietorship is what we call a tax nothing. From a business standpoint, the business doesn't file its own tax returns. It will file a schedule that goes on what's called Schedule C that'll flow under your individual tax return. Okay, so that's how a sole proprietorship sort of gets done. And the thing is, without getting into too many of the details, when the IRS first started running into this LLC, they didn't really know what to do with it. And I think that, after some, as my old Navy buddies would say, cussing and discussing, I think they just, eventually it came down to hey guys, you tell us what rules you want to play under, we'll let you play under those rules. And so what they do is that they set up a default. So if you have a limited liability company owned by one person, for example, Beta Solutions CPA is an LLC. We're not taxed as an LLC because there is no tax as an LLC. We actually had to make an election to be taxed as an S corporation. Okay, and that's something that's very common with LLCs. But a single member owned LLC is not defaulted to an S corporation, it's defaulted to a sole proprietorship, which basically means that I throw it on Schedule C and I fill it out just like as though I have a sole proprietorship. If you have an LLC that is owned by two or more people, the default is not sole proprietorship because obviously sole proprietorship is owned by one person. That's why it's called sole proprietorship. It is actually defaulted to a partnership. So when I was taking a look at the situation that they're giving for the class here, they're talking about converting a general partnership to an LLC. I was kind of looking at it going, from a tax perspective, they're one and the same. Why would we have to do this? And it's actually kind of interesting. First of all, the conversion is not treated as an exchange regardless of how the conversion is accomplished for state purposes. The conversion of the LLC's interest doesn't result in gain or loss to any partners, doesn't affect the basis or holding to any partners, and doesn't terminate the partnership for any tax purposes. Accordingly, the LLC will continue to file partnerships using the partner's employer identification number and tax year. And if you think about it, it's basically the swap. That's what's going to happen here. From a federal perspective, they're not going to see any difference. Okay, because the federal tax doesn't care about your limited liabilities in terms of changing from a general partnership to an LLC. How does that affect things? Now, it could affect the taxation of the partners. That's a different story, and we'll get into that here in a little bit. But the actual partnership itself, there's no difference. You're just kind of moving from one entity to the next, but the new entity is going to use all the identifying factors of the old entity there's, as some of my political friends would say, there's no there there. You don't have to worry too much about it. Now, if the conversion results, now that's assuming that it results in no shifts in liabilities, okay? If the conversion results in a shift in partner shares of the liabilities, the partner's shares whose shares are increased are treated as making contributions to the partnership, and the increase in the basis of the partnership, and those whose shares are decreased as a result of this are treated as receiving distributions. That could have a tax effect. Okay, depending on what your basis is and depending upon other extenuating factors that we're not going to get into here. Suffice to say, guys, if you're doing this, even though I've said that it's probably not there's not a whole lot of there, you still want to make sure that you're consulting with a CPA, because they're going to actually get into the facts and circumstances and make sure that what you're doing is actually correct. Okay, so that's something that you want to make sure that you're doing. The conversion of the LLC a partnership to an LLC may cause a change in the share of partnership debts. So where we could see a potential shift in the liabilities that's going to occur, in a general partnership, what ends up happening is that if you are in a general partnership with another person, for example, I have a friend of mine who's a CPA, say he just walks in and we just decide, we've been working well together for years, let's go ahead and merge into a partnership with each other, and we decide to have it taxed as a partnership, and it's a general partnership. First of all, the two of us would never do this. This is something I would never recommend to any of my clients, but say it does happen. We have a general partnership. What happens is that once that partnership is formed, each of us is jointly liable and severally liable for all of the partnership debts. Okay, so if my friend decides, and he's from Jamaica, he decides he's going to go on a family vacation and never return, I could potentially be liable for all the debts of the partnership regardless, and that could make things very, very nasty for me. Once you move from a general partnership to an LLC, now depending on how it's worded and how it's structured and how the operating agreement is set up, I may only be responsible for my half. And if I'm only responsible for my half, now my debt basis in the partnership interest is going to change. So there's going to be some changes that's going to happen here. Sounds real complicated. You should be talking to your CPA about this. Okay, and I know I say CPA or tax attorney. Not to knock the EA industry very much, but you probably want somebody who's got a lot of experience in this. And not that I'm trying to knock the EAs. I have a lot of EA friends of mine who are very competent in what they're doing, but a lot of them are people who work more on the individual side. They're not the people who work on the company side. Now, if you get an EA who specializes and works in the business side, phenomenally good. Use that individual, but just make sure that you're choosing the right individual. CPAs, because of the nature of our license, we have to be smart on the business side of things, and so generally, if a person's a CPA, I'd probably be more likely than not to trust that individual than some of the other credentials. Obviously, a tax attorney, you could probably get away with some of that stuff, but you want to also make sure that that person has a lot of business entity work. Partnership debts that were formed as recourse may become non-recourse. So, for example, my accounts payable. Maybe it is recourse debt when I set it up. Now it becomes non-recourse as part of the LLC under the state laws. All of a sudden, I've now changed my partnership debt. So you need to do a complete debt analysis when this ends up taking place. So like I said, this is an interesting, very interesting topic. I did choose it. Like I said, at first I was kind of like, there's no there. And then as I was beginning to realize, I was like, holy smokes, there's really a lot more into this than I really originally gave it credit for. So I'm actually very glad that we got a chance to work with it. Again, my name is Kevin Matthews. I am the tax professor. I want to thank you for coming to the Tax Academy. Your class is always in session because the learning never stops. If you have a question about this topic or any other topics that we bring up, go ahead and leave a comment in the comment box below. If you want to ask me more directly, you can go to my website at www.betasolutionscpa.com. Again, that's www.betasolutionscpa.com. Also, if you like this video, please go ahead and hit like. We really would appreciate that. And then if you don't, if you don't mind, also please go ahead and hit subscribe, as we're trying to spread the word about these videos, and hopefully people can learn from them. Again, thank you very much.